decentralized finance as a we're going to be talking about decentralized finance as a tool for global economic equality. And just to kind of start this conversation off, of course, want to thank the Africa Blockchain Institute for once again bringing me to their platform. Very happy to share this information with people on another continent altogether. So this is a great opportunity. I really appreciate it. And we'll talk a little bit later about my book that also talks about this because there's amazing potential. So just to get things started about me, um, you know, pretty much a civil rights officer. I'm a lawyer by training and did some postdoc work at Stanford's Rock Center for Corporate Governance, which is a joint collaboration between Stanford's Law School and Graduate School of Business. That's where I first came across Bitcoin blockchain. I spent 2 years doing independent research, and through the course of that research, I became certified in fraud examination to understand where the fraud schemes present themselves in blockchain and crypto, cybersecurity, so that I can understand how to protect and lock down those digital assets. And then later became certified in decentralized finance. And from there, I've had an opportunity to testify in front of the California Senate Banking Committee, advocate on lawmaking efforts around blockchain in the state of California as well, and had some advocacy efforts in Washington, D.C. as well, and wrote a book called DeFi for the Diaspora, which once again, I'll talk about a little bit later. So, this talk is all about DeFi as a global economic tool, right? So I think it's important to understand that when we're looking into where inequality lies globally, I think this is one of the best stats to look at in terms of who has access to financial services and who does not, right? I mean, if we're just looking at the highest stats here, Africa and the Middle East, they have among the highest uh, statistics when it comes to being unbanked. Um, Latin America and the Caribbean are come in a very close second here. So, really the global South is has a high number of unbanked individuals. This doesn't even account for people who are underbanked, who are just getting minimal financial services. So, in looking at this stat once again, it's a loss of $250 billion in global GDP due to people being unbanked. That's not even, once again, taking into account folks who are underbanked. Now, to move forward here in terms of, just the overall inequality, there is a, a I guess, a pattern that we've seen throughout history when it comes to, Black people within the diaspora in general. There's unequal banking practices. And in the United States, just speaking from a perspective of the United States, excuse me, we have to look at policies like redlining and the denial of access to capital. And I don't think that these policies have their own, mirrors and counterparts throughout other parts of the world. They present themselves differently, but it's still the same thing. It's a denial of access to capital. And there was a Citigroup study in 2020 that came to the conclusion that racially discriminatory practices have cost the US over $16 trillion over the last 20 years. So that's just the United States. Once again, if we start factoring in these discriminatory practices across the board globally, I can only speculate, but once again, you can probably add that by a couple dozen trillion dollars. Another important statistic to look at, and once again, this is really focusing on the United States, is the racial wealth gap. And you can kind of see here that going from, the 90s to the 2000s, a significant amount of wealth was lost in minority communities, in particular, Black and Brown, when we're looking at the United States. And then here's another statistic too, really just showing that, when it comes to median family wealth, there's some families that have 100 times more wealth than other families. So, I think these stats are pretty well documented. They're also pretty easily obtainable and easily found in various places. So most likely you've come across these. And now getting into why, cryptocurrencies are important now, and why people should really focus on how they can begin accumulating digital assets is, looking at the countries that own Bitcoin, right? And these numbers are only going to increase. Countries like the United States and China are only going to continue to accumulate Bitcoin in particular. And the United States has created a strategic cryptocurrency reserve. So now nation states are taking the accumulation of cryptocurrencies seriously. So I do think that individuals should be taking it seriously as well. And now that nation states are accumulating Bitcoin and other cryptocurrencies, corporations are following suit here. And one financial analyst predicted that Bitcoin may be on 25% of the S&P 500 firms' balance sheets by 2030. So in that way, I think, once again, individuals should be looking at having their own crypto reserves, as well as families, communities, so that we're not left behind, essentially, right? Hopefully that can level the playing field so that people can have access to their own digital currencies as family or individual treasuries. So I think to start, I think we have to start from the beginning, and this being the Africa Blockchain Institute. I'm sure there's plenty of resources out there on Blockchain 101, but for the sake of discussion here, I want to move through what blockchain is. And blockchain technology is the underlying technology that powers Bitcoin and other cryptocurrencies. It is open and permissionless, meaning that anyone, anywhere can access it. Such a level of openness has the potential to solve the problem of inequality that is inherent in the current legacy financial system, because all a person needs is an internet connection to interface with cryptocurrencies and decentralized financial protocols. Second, the records kept on the blockchain are distributed and scattered across many devices. There is no central server or body of authority that has exclusive powers over the entire system. And to go in a little bit further in terms of how this works, one way to understand blockchain better is to think of it as a type of database. Databases are used as software to store, process, and query information. Blockchains are publicly managed and verified records of transactional data. All the all of the chain's old blocks of data are permanent and they can't be modified or altered retroactively. And in this process of having a verifiable record, there's a process of what's called consensus. So nodes are electronic devices connected in the network in many different locations. As I mentioned earlier, these nodes are responsible for maintaining the transactional records on the blockchain. Blockchain is only able to be updated through this process of consensus. So many devices and many places agreeing on what's taking place when it comes to the transaction. So that is, the participants in the chain system must agree on additions and changes to the chain itself. The process of consensus varies from one blockchain to another. So consensus on Bitcoin may be different from, or is different from Ethereum and other networks. Consensus is important because it is integral in the process of validating transactions to keep the ecosystem fair and prevent things like double spends, right? So I can't take one Bitcoin and send it to someone as a form of payment and then somehow retain that Bitcoin and send it to another one. That's the double spend problem. So if we look at this infographic here, we have a chance to see how which industries can actually benefit from blockchain. And there's a multitude. Obviously, financial services, the energy sector, insurance, media, the medical industry, the real estate industry, so on and so forth. There are many different use cases that are available for that can benefit once again from blockchain technology. So that was a quick overview of blockchain. Now we're going to get into cryptocurrencies. Cryptocurrencies are borderless, cryptographically secure, decentralized digital assets that leverage blockchain technology. Cryptocurrencies facilitate peer-to-peer transactional exchanges, enabling direct financial transactions with reduced fees and increased transparency to traditional currencies. And according to CoinGecko, there are over 17,000 cryptocurrencies in circulation currently. Now, a lot of people wonder, what is the crypto and cryptocurrencies? So cryptocurrencies and blockchain rely on cryptography, and that cryptography is utilized in the blockchain to create secure, trustworthy digital environment. Cryptography utilizes public and private keys to allow secure communication and verification of information. The process involves creating a unique digital fingerprint, what's known as a hash, and allowing for tamper-proof verification of electronic data. Now, when we're talking about cryptocurrencies, have to mention Bitcoin. It's the number one asset by market capitalization. And Bitcoin is regarded, once again, as the first cryptocurrency in 2008. It was released by Satoshi Nakamoto through a white paper entitled Bitcoin, a peer-to-peer electronic cash system. And unlike traditional currencies issued by central banks, Bitcoin operates without a central authority, relying instead on a consensus mechanism known as proof of work. So I mentioned consensus earlier, and that is the mechanism that operates within Bitcoin. This mechanism involves miners who use computational power to solve complex mathematical problems, thereby validating transactions and adding new blocks to the blockchain. Bitcoin. Whoops. Let's go back to Ethereum. So Ethereum is a decentralized platform that allows developers to build and deploy what's known as smart contracts and decentralized applications, otherwise known as dApps. But unlike Bitcoin, which primarily focuses on peer-to-peer transactions, Ethereum extends the functionality of blockchain technology by incorporating a programmable layer that allows for the execution of complex computational tasks. The native cryptocurrency of the Ethereum network is known as Ether, which is used to pay for transaction fees and computational services on the platform. Ether also serves as a store of value and a medium of exchange within the Ethereum ecosystem. So earlier, I mentioned smart contracts, and smart contracts are self-executing directives with the terms of an agreement directly written into the code. They automatically enforce and execute the terms of a contract when certain conditions are met, reducing the need for intermediaries and minimizing the risks of errors or fraud. Decentralized applications are applications that run on the blockchain and operate without central control. dApps can provide a wide range of services from financial tools and gaming to supply chain management and social networks, all benefiting from the security and transparency of blockchain technology. Ethereum operates under what's known as a proof of stake consensus mechanism, where validators are selected to create new blocks and validate transactions based on the amount of cryptocurrency they stake as collateral, replacing the energy intensive mining process of proof of work that Bitcoin operates under. Ethereum has become a vibrant ecosystem of blockchain projects, including ERC20 tokens, decentralized finance, non-fungible tokens, also known as NFTs, and various other innovations. So in this infographic, there is a side-by-side comparison of Bitcoin and Ethereum and where they are different. And it's important to note that recent developments have allowed for smart contracts to operate on Bitcoin. So I know there might be people who are saying, hey, there's smart contracts on Bitcoin. Yes, there are. It didn't start out like that, but that's becoming new. Bitcoin DeFi is something that a lot of people are excited about, and that whole ecosystem is now taking shape. So, you know, a lot of these things are changing every day. If you are involved in blockchain and you know this, then this is something that, like I said, most folks are already aware of. Now, some terms to keep in mind when it comes to Bitcoin, crypto in general. Here's a whole list. People may throw these sort of acronyms at you like FOMO, FUD, DYOR, so on and so forth. But this infographic, once again, just kind of goes through some of the basic jargon and lingo that's associated with crypto that I think people should probably get familiar with. And I'm going to move on to the next slide, though. So now, as we're moving outside of the cryptocurrency area into decentralized finance, it's important to understand the difference between centralized and decentralized exchanges. So centralized exchanges are essentially like Binance, Coinbase, KuCoin, and others, where you go to either buy and or trade your crypto for other assets. And so you can kind of see the difference between that and a DEX, or all what's known as a decentralized exchange. Is DEXs operate more on a peer-to-peer basis, and it's also a non-custodial way of trading digital assets. So, I'm not going to go through every one of these, but this is a side-by-side comparison. So if you're watching on the playback and you want to pause this just to look at the differences, feel free to do that. But I think the main point of centralized and decentralized exchanges is the difference between custodial wallets and non-custodial wallets. So with custodial wallets, that means somebody else has custody of your crypto and control over those private keys. So going back to the Coinbase and Binance examples, you go to Coinbase with your crypto because you say, hey, I want a different type of crypto. And in that process, what happens is you send your crypto to the exchange. They put it in a wallet that they have control over, or at least legal title over. They have those private keys and the ability to unlock that crypto if they need to. They allow you to have control to make those trades, but at the end of the day, they own the keys and you do not. Whereas in a non-custodial wallet situation, users have 100% control over their private keys. So these are wallets like MetaMask or a Ledger wallet or a Trust wallet, so on and so forth. And once again, you have access at all times because you have the control over your private keys. So, sorry, I advanced a little bit too far there. Now, getting into what is decentralized finance. Decentralized finance is a trustless peer-to-peer system that eliminates the need for third-party intermediaries. DeFi is a growing subsector of blockchain technology that provides users with open access to financial products such as loans and interest-bearing accounts. And the realm of decentralized finance is continually growing, but at its core, it started out with these main types of protocols that include decentralized exchanges, which I mentioned earlier, decentralized money markets, decentralized stablecoins, decentralized insurance, options, and derivatives. So let's talk about decentralized money markets. And all these are it's just like it sounds. It's a market that you can go to either get money in the form of a loan, or once again, you can take your money to this market and loan your money to get an interest rate, essentially. So people can go there to lend and borrow. And that's how decentralized money markets work. Most of the time, these are collateralized. So if you go to a money market looking for a loan, you do have to bring your own crypto as collateral to say, hey, I'm coming to this market with $100 and I'd like to put it up for a $75 loan. By the time you pay that loan back, you get your collateral back. But you have the option, once again, to take equity out of that crypto and use it to do what you need to do in a near-term situation. So, in terms of having access to credit, you don't have to worry about uh, you know, credit scores or any other decision from a third party that can possibly prevent you from getting a loan. Decentralized money or stable coins are just that. These are digital assets that tend to be fixed to the price of a commodity or a currency, outside commodity or currency. So stable coins can be in the form of gold, oil. They tend to be in the form of dollars or other currencies. And stablecoins help to hedge against the volatility of very variably priced cryptocurrencies that have market swings, several market swings throughout a given day. Decentralized insurance is a way of creating new types of insurance policies that, once again, do not go through insurance companies to make decisions on how claims can and should be paid, right? So this way, a group of individuals can come together under a common interest. It could be life insurance, it could be malpractice insurance for professionals, it could be car insurance for drivers, and everyone who is involved in paying premiums regularly can essentially come up with a way of democratically deciding which claims are legitimate and which claims should be paid, right? So let's just say in a life insurance context, you have 20 people in a pool that have been contributing to uh, their premiums monthly. Someone passes away. Well, hey, what was their proportionate share of the pool? And It's pretty easy to know and to verify when someone passes away. You get a death certificate. I know it's a little morbid, but this is the best example I can think of at the moment. That death certificate is presented and people will vote to say, okay, how much of the pool does this person deserve? And then that premium gets paid out, or excuse me, the claim gets paid out. So that's how decentralized insurance works in a nutshell. Now, decentralized options and derivatives trading is just that, getting decentralized options contracts and trading on those, as well as derivatives, which essentially means assets, and then having the ability to trade them on decentralized markets. So an example would be taking it and then being able to trade it on a decentralized market. So you don't have to go to a TD Ameritrade or a Charles Schwab or any other investment bank to have exposure to those assets and be able to trade on those assets. And, it just creates new financial services, once again, that you don't have to go to a bank to get. And now, as we're moving forward in tokenization and decentralized finance, there's this new paradigm that's opening up around the tokenization of real world assets. And tokenizing real world assets on DeFi platforms enables fractional ownership and increased liquidity, right? So if I wanted to tokenize my car, for example, right? So that, you know, Uber drivers can use it, and people who just need a car to rent for a day, right? I can take my car, tokenize, people can then be a part owner of my car, and as that my car is utilized by other people, like I said, people want to rent my car for a day, or really just rent my car for a day, the other fractional owners of my car would get a piece of taking these assets and either becoming an owner in them or having the ability to use and have Fink, who's the CEO of BlackRock, which is the largest financial institution with assets under management globally, says that he wants to tokenize everything. And I don't want to get too far into examples here because I provided an example of real world asset tokenization. But, when someone like that is saying those sort of things, it's time to, once again, to begin paying attention. And, naturally, when we're talking about real world assets, the tokenization of real estate also becomes its own thing, right? So now, Airbnb, you can have Airbnb owners who tokenize a home if they want to have access to liquidity on that property, but provide people with streams of income through Airbnb or some degree of property share, or other rights. I'm just using Airbnb as an example, but there's many other options out there. Decentralized science. Here in the United States with the current administration, funding for scientific research is getting cut at several universities and institutions of higher learning. So now what this means is, people who don't have access to traditional funding mechanisms, but have the ability to invent and create and research medicine and other areas of science, they can get it funded in a decentralized manner. Essentially, it's like a tokenized GoFundMe where you have a research project and you present some degree of academic documentation, and then the people who want to fund your research can fund your research. And there's no shortage of intellectual talent throughout the world that is not currently getting their projects funded. So this is a new vehicle, once again, to fund these projects that could also lead to new breakthroughs in science. So that's very important, because if governments won't fund it, that means, we can fund it, and who knows, could make or create the next super drug, or it could be the next quantum physics breakthrough in quantum physics. We don't know. And quickly want to touch on hardware wallets, right? Because these are a way to secure digital assets at a higher, more secure level. And all it is a physical device used to store crypto, as opposed to a software device that can have a little bit more vulnerability in being connected to the internet. With a hardware device, the secret or the private keys to that wallet are on that physical device. So that's important to know. And anyone who wants a little bit more information on how that works can look into it. But most important thing to keep in mind, as assets become decentralized, money becomes decentralized, what has value now is data. And your data in particular is also going to be valuable. So as Web3 and Web4 and Web5 begin to build out, the question is, how can we take our data as individuals and leverage it for our own best interests, which essentially means, how can we profit from our data, as opposed to data brokers out there who get our data for free and then sell it to other people? How can we take those data brokers out of the mix? And now we become the people you have to negotiate with when it comes to what data is available for people to use. This is, like I said, this is paramount in a Web3 paradigm. We need to be able to, once again, profit from our own data, come together collectively. That will help, in my opinion, to combat inequality globally. And so I want to take this time to thank everyone once again. If anyone's interested in learning and taking a deeper dive into decentralized finance, you can find my book, DeFi for the Diaspora, at defiforthediaspora.com, as well as my workbook, which is the Decentralized Finance Action Planner. Now, this workbook is a way of organizing how you interface with decentralized finance. And it's also available on my website. Now, I will say this as well. Due to the message and messages in my book and who it aims to empower, this book has become shadow banned in certain locations and geographies. So if you go to my website and you're unable to get a physical copy of the book, there are electronic versions of the book that you may have access to. So I say that to say, if you do go to the store and you're not able to get it in your jurisdiction, feel free to pick up an audio accessible to folks. So I'd love to open things up to questions at this time, in case anyone has any